Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland, here with, as always, John Paul Hampstead. JP?
Thanks for having me on, Zach.
Yeah.
Wow, it's great to be here.
I know, another week. And we've had some pretty significant shift in the market. So in the previous weeks, we were talking about how it really hadn't fallen apart like it had. We were in January. Volume's traditionally softer in January.
Right.
We expect it to slide out. But capacity really didn't show that until just recently. We last week
the past few days we've seen pretty major deterioration in the outbound tender rejection rate for the nation, falling. Now, we were talking about kind of holding steady at 7.5%, which is right at the level that should be supportive of higher spot rates.
Right.
Now it's dropped to below 6%. So it's now you're and it's still good. It's probably going to go down further. So it's above 5%, which is very loose capacity.
I think the lowest it got last year was in August, and it was about 3.3%.
Right.
And so that's about as loose as it got last year. Now, it had its undulations in there, but yeah, we are heading into February, which isn't necessarily a high volume type capacity month either.
No, it's not. And on the C.H. Robinson earnings call, CEO Bob Biesterfeld, they have their own metric for sort of gauging capacity in the marketplace. They talk about routing guide depth.
Right.
So what is the average position in the routing guide that a load gets accepted? Would they consider a 1.4 a balanced market? But they said that right now it's a 1.2, which is quite a loose market.
Very loose.
And that's consistent. That's been consistent over the past few quarters. So they kind of really see a return to normal. The other kind of interesting way to get at capacity, though, that some people have been talking about in our Slack channel is, at least the way to get at capacity from the publicly traded companies' data, is to look at the Landstar number of BCOs. The owner-operators that lease on with Landstar, they're sort of contracted operators or whatever.
Huge fleet of owner ops.
Yeah, and so that tends to move up and down with the sort of industry as a whole. And that's come down. I mean, they still have something I want to say 9,200 BCOs, but it's come down by several hundred Q3 to Q4.
So why does the decline of BCOs have a significant? What is that telling us?
I think it's telling us that people that are trying to make it on their own are either not profitable enough, or they have higher costs or whatever, that they're leaving the industry. I think that it's when people feel when sentiment is high and people expect growth and rate inflation in the trucking market, that's when people tend to strike out on their own and start driving for themselves.
You traditionally see this transition from larger fleet to smaller fleet to owner-op. It's like a waterfall of people that go when you start to see the market heat up, higher spot market rates, everybody gets excited.
Right, and so when the owner-op market tightens up, that maybe that's a leading indicator that some capacity is starting to leave the market. Which would conform to our expectations. There's always the risk of kind of confirmation bias, but it wasn't some long-term industry watchers had kind of told us to look at this number, and it's been pretty interesting.
I think one of the things that is shocking about this, though, is the fact that it takes such a long time for us to really see this materialize.
Yeah.
We've been watching it for a long time.
It really does.
We were looking back in early 2019, and we were looking at used truck prices, and they were still elevated. They were still getting propped up. There was still a lot of people. I remember I heard somebody was like, dude, there's no way they're buying a truck right now. They absolutely were still buying trucks early in 2019, even though the conditions showed us that probably wasn't the best time.
Yeah.
But the financial cycles of things, think about your budgets that you're making, you're making plans. I think we talked about it last week. You buy a car, you don't set that up Wednesday and then go out to the lot on Thursday. You're making this decision over a long period of time.
Right. Yeah, you're looking for a driver. You're talking to customers. You're comparing models. You're getting your money together, et cetera, and think about where you're going to operate and why. Right. And yeah, it isn't like a spur of the moment thing. And of course, exiting the industry is also not a spur of the moment thing. Right. So it does take a long, and even the way that like the economy reacts to a Fed decision or something like that, like right. takes 6 months for things to trickle down.
Really the impact of the decision.
It's on the one hand, it's not surprising, but you would think that like with faster news cycles and transportation, with more data, that things would start to inflect quicker. But I think there's just so many moving parts and so many decision makers. And what we can talk about like national average spot rates, but of course, no one's actually no owner operator is exposed to the national average spot rate.
True. And those are aggregate or indexes. They're not necessarily in the moment. Like that your rate from Dallas to Atlanta is moving, that you're running every day or
right.
Every other day, but you don't know what that means in the context of the bigger
right.
picture.
Right. So there have been different rate environments and volume stories in different parts of the market, and I think that also kind of delays and waters down any kind of like sudden snapback.
A lot of anecdotal evidence. If somebody has a hot spot over in the West Coast, they get excited.
Or they have a customer that's not particularly price sensitive.
Right. Cyclical customer who's pretty stable.
Yeah.
They don't move a lot. Yeah. But yeah, the market has been pretty stable, I would say, even though it's been a very soft market, but it's been relatively stable for the last several months.
Yeah, volumes year over year are pretty flat. I think they're up 20 basis points over year ago levels.
Which is nothing, effectively.
Yeah,
I mean, it's basically a flat market.
It's flat. And although I have talked to freight brokers who said that spot rates are crashing again, and with capacity loosening. So, that's something to look out for. I think that the other big downside risk that we should talk about is what's happening in the Southern California ports.
Yes, so just recently, actually today, we were watching the O-Tri fall off a cliff, if you will. Fell back under, I think it went all the way back down to October levels overnight, fell from roughly 4.9% down to under 4% and one move. But volumes didn't reflect that. So it wasn't necessarily just volumes crashing. But we have the port of Los Angeles, Long Beach out there. Chinese New Year was this week.
Right.
And that has an impact, but it doesn't impact the freight market right away. It has about a 4 to 6 week lag before it really impacts us. So the stuff that's going on in China right now, we're not going to see that in practice until probably late February. And this coronavirus situation, I mean, it's starting to escalate quite a bit, correct?
Yeah. So, I mean, it's always important to keep in mind that there's about a 15-day transit time from Shanghai to LA.
Mm-hmm.
That's direct.
That's if they go
straight, which they never do. So a lot of times they'll hit Prince Rupert first in British Columbia, which is actually the shortest route to Asia, and then we'll kind of work their way down Oakland, LA, something like that. So it could take 3 weeks even to get to LA. But we did see a report this morning from the maritime news site Splash 247 that Chinese ports are starting to declare force majeure with regard to the coronavirus. Now, force majeure essentially means that due to external factors and circumstances out of your control, you're not going to be able to make your contracted obligations. And these port operators are saying that because of the quarantines, because of the limitations placed on freedom of movement, and curfews and everyone being told to stay inside their houses due to coronavirus outbreaks, they're essentially running out of stevedores, dock workers, and truck drivers to move freight in and out of the ports, and things are getting congested and slowing down. Coronavirus confirmed infections are around 10,000 now. So, and they're not really slowing down. We expect this to get worse for the next month, basically.
Wow. So compare it to the SARS outbreak back in 2002 or so.
Right. So we now have more confirmed outbreaks, we now have more confirmed coronavirus infections than the SARS had in total.
Right.
Much lower mortality rates so far, although that data is always like pretty tricky to deal with because confirmed infections tend to lead the death rate because
Gotcha.
it takes a while to die
Catch up
and all that kind of stuff. But I mean, I think the bigger thing is like the infections aren't really slowing down. They're spreading. We're getting human to human transmission in more countries, not fewer. Every major city in China is being affected, and the big risk here is that you take what's traditionally like the trough of the West Coast freight markets, the Chinese New Year impact. You deepen that and extend it, kind of, indefinitely. No one
because
really
we don't know. I mean, it's still getting worse. So as that's happening, they're still going to have trouble fulfilling their contractual agreements.
Right. So that's going to drag on West Coast volumes and ultimately on North American freight volumes.
I was going to say, it's not just a West Coast situation because we have seen this shifting of volume to the East Coast here in the recent months, if you will. The Port of New York, New Jersey is growing.
Right.
As a consequence, the outbound volumes out of the New York market,
Elizabeth, especially.
Elizabeth, New Jersey, have been growing. So it's going to, and that takes about 6 weeks to show up there. So again, spring may have a pretty decent impact. Now, the good news, I guess, if you're in freight, is that the trucking markets don't necessarily depend on that volume in the spring and summer months. A lot of that happens in the fall and winter.
Right. So depending on what kind of retail goods are kind of in season, certain customers may be more or less affected. Mm-hmm. We do know that the inventory to sales ratio is back up around 1.4, which is sort of like a historic
It's kind of
high normal. Yeah, it's kind of, the inventory to sales ratio has been strange. In the 90s, it was really high. Then there was this whole sort of movement toward like lean shipping and things like that brought it down very low. And then the rise of e-commerce with the pre-positioning of inventory close to consumers in multiple locations has brought it back up. 1.4 is like an equilibrium level. That's kind of where they are now. So I think there's plenty of room to run for shippers or customers to run that down if they need to.
Right.
So far, I don't think the impact hasn't been that great, right? So far, we're still sort of seeing the normal Chinese New Year effect emerge. Whether it gets, how much worse it gets, and for how long it's like that kind of remains to be seen.
Yeah, and we're also in this kind of contracting space anyway because of the trade war situation being, I guess near resolved, but not really resolved. But we're not seeing the influx of freight coming into the United States like we were last year.
Yeah, I mean, directionally, I think the trade war is sort of shifted toward de-escalation, and so I think shippers are going to be less panicked about needing to like rush freight onshore to avoid more tariffs. That doesn't seem to be what markets expect. Right.
Well, I guess we'll have to see. We've got about 4 to 6 weeks before we really start to see the beginning of this impact. But in the meantime, LA's already softening quite a bit. So we'll find out. Well, that'll do it for this week's On the Spot. Thanks again for watching, and everyone have a great week.